All right, no fluff. Let's get straight into it. Morgan, my man, picture this. You've been grafting, you've saved up a bit of cash, you put it into like 5 different companies you think are solid. You check your phone a month later and you've been absolutely rinsed.
Oof.
Everything's in the red. You thought you were being smart,
Yeah.
you thought you were diversified. What's gone wrong, bro?
Mate, you've just walked face first into the oldest trap in the book. You thought you bought 5 different stocks.
Right.
But what you really bought is one big, risky idea. You've ignored one of the most important words in the CMT playbook.
Which is
Emphatic correlation.
correlation. Sounds like something my headmaster used to drone on about. Break it down.
Yeah.
Make it make sense for the man on the street who just wants to not lose his shirt.
Dead simple. Think of it like your mates. You've got that one mate. Let's call him Dave.
Okay.
Everywhere you go, he goes. You hit the gym, he's there. You go for a pint, he's already at the bar.
Right.
You two are positively correlated. In trading terms, that's a +1. You move together.
I know a few Daves.
Clingy. Exactly. Then you've got your other mate. Let's say it's his missus.
Uh-huh.
When she turns up for a lad's night, he's out the door. They move in opposite directions.
Okay.
That's a negative correlation, a -1.
Right, I get that. So what's a 0?
That's your weird cousin who just shows up randomly to family events,
Yeah.
does his own thing, and leaves. His movements have got nothing to do with anyone else.
Right.
No relationship. That's a 0. In the market, it's just 2 assets that couldn't care less what the other is doing.
Okay, so mates, numbers, I get it. But what has this got to do with my 5 stocks getting battered?
Everything. You probably bought like 5 different tech companies. Maybe a Google, a Microsoft, a smaller AI firm.
Okay.
On paper, they're different companies, but in reality, they're all in the same gang. They're all Daves. When a bit of bad news hits the tech sector,
Yeah.
they all fall off a cliff together. That's a high positive correlation, probably like plus 0.8 or 0.9.
Okay.
You weren't diversified.
Ah.
You were concentrated.
So I built a team full of strikers.
Yeah.
Looks amazing when you're scoring, but the second the other team gets the ball, you've got no defense.
That is the perfect analogy, mate. That's it. Correlation analysis is your scouting report.
Right.
It tells you if you're buying a defender, a midfielder, or just another striker. The whole point of proper diversification, proper risk management, is to build a balanced team. You buy some stocks, right, which are your strikers, but you also buy some bonds or maybe a commodity like gold, which can act as your defenders.
So gold is the hard man center back of the portfolio?
Pretty much. Gold and the US dollar, for example, are famously negatively correlated. When people get scared and pile into the safe haven dollar, the price of gold often drops.
Okay.
And when the dollar weakens, gold tends to get a bid. So holding both gives you balance. If one is getting hammered, the other might be having a blinder.
Wow.
And your overall portfolio value doesn't swing about as wildly. You can actually sleep at night.
Sleep is good. I like sleep. So, okay, it's a defensive tool, but we're the big short club. We're not just here to play defense. Can you use this correlation stuff to actually go on the attack?
Yeah.
To find a trade?
Oh, 100%. This is when it gets a bit cheeky. It's a strategy called pairs trading. You find 2 stocks that are basically twins. Historically, they've got a massive, like, plus 0.95 correlation.
Wow.
Let's say Shell and BP. They both sell oil. Their charts look almost identical for years.
Okay, the 2 Daves.
Exactly. But one Tuesday, some news comes out, and Shell's price proper jumps up 5%.
Whoa.
But BP just sits there, doesn't move. Now, the historical relationship, the correlation, it's broken. It's out of whack, so there's a gap. There's a gap. The pairs trader would look at that and say, history suggests these two get back in line. So they'd short the one that's shot up, Shell, and go long on the one that's lagging, BP. They're not betting on the whole oil market.
Right.
They're betting on that relationship snapping back into place.
That is naughty. You're basically betting on things going back to normal. What's the risk then? What if the relationship is broken for good?
And that's the million-dollar question, isn't it? What if Shell just discovered a magic oil field and BP's main rig just blew up? The correlation is broken permanently. The fundamentals have changed. If you're on the wrong side of that, you get absolutely torched. So it's not a free lunch. It's a tool, a powerful one, but you can't use it blind. You still have to know why things are moving.
So the big takeaway is correlation isn't just a boring spreadsheet number for nerds. First, it's your first line of defense. It stops you from accidentally putting all your eggs in one basket. Check the correlation of the stuff you own.
Yep.
If it's all plus 0.9, you need to sort it out. Fact. Second, it can give you a bit of confidence. If you're bullish on the S&P 500 and you see that other markets that are usually correlated are also moving up, it's a good sign. It's like seeing your mate Dave and then seeing his other mates turn up too. The whole gang is here.
The trend is confirmed.
And third, if you're feeling a bit bold, you can use it to find these pairs trades. Look for those relationships that have temporarily snapped and bet on them getting back together. So it's defense, confirmation, and attack.
That's it.
All from one little number. Mad.
It's fundamental, mate. You can't be a proper technical analyst without getting your head around it. It underpins so much. But remember the big warning.
Okay.
Correlations change. In a real market panic, a proper 2008-style crash, all correlations go to +1.
What do you mean?
When the ship is sinking, everything goes down. It don't matter if it's a stock, a bond, crypto, a painting of a boat.
Wow.
Everyone just sells everything. The defenders, the strikers, they all run for the exit at the same time. So it's a powerful tool for normal market conditions.
Right.
But in a true crisis, all bets are off.
A lesson in itself, right? That is a proper masterclass, Morgan. Nice one. For everyone listening, if you want to get into the nitty-gritty of this stuff or just have a laugh about the markets, you need to join our community. The link to the chat group is down below. Hop in, say hello, ask a question, and have a laugh with us. Don't be a stranger.
Get involved.
Now, here's a question we'd like you to think about. We talked about Shell and BP. What other pairs can you think of in the market that move together like twins? And have you ever seen their relationship break? Have a think on that. We'll see you in the chat.